Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We're counting down to the next VRIC, January 21st and 22nd, 2024. Stay tuned for tickets. And today's guest is a portfolio manager at Crescat Capital, a global macro asset management firm whose research is being featured on Bloomberg, the Financial Post, Real Vision, and more. It's Mr. Tavi Costa. Great to have you on.
Thanks for having me. Looking forward to this.
Yeah, me too. So I want to start with an article posted on the Crescat Capital website where you mentioned a trifecta of macro imbalances caused by US policymakers. So I'd like to go through them one by one and get your thoughts on how they're affecting the economy and financial markets today, starting with historic overvaluation of long duration financial assets. Could you talk about that for us?
Yeah, I think that research really began when we looked at historically and really seeking for an analog for today's macro environment, and it's just impossible to find one. Over the last century or so, all you can find is periods that had high debt, other periods that we had high valuations, and other periods that we had high inflationary periods too, but not all three at once. And that is what we call the trifecta of macro imbalances, which is the debt problem of the 1940s, very similar in terms of the degree and the magnitude of the debt issue. And the second one is the inflationary problem that I think a lot of people are dismissing, especially now, given the cyclicality factor of that, although it seems to me that is very much structural. And the third one is the valuation problem, which we didn't have in the 70s and we didn't have in the 40s, which has to do with expectation for returns that I think are really unrealistic given where prices relative to fundamentals are in today's markets. And so that is, I would say, very similar to what we experienced back in the late 90s during the tech bubble. And so you put it all together, it seems to me that we are approaching a place where it's hard to believe that tangible assets will not outperform financial assets in this place, and long duration assets is specifically inside of those financial assets in general are, to me, the ones that need to be repriced much lower. We've got secular forces going for both trends that we can talk about. But to me, that's really where investors need to be focused for the next 5 to 10 years. There's a lot of different sub-themes that you can create through that. Can mega caps continue to, really outperform the rest of the market, given what we're seeing? I don't think so. I don't think you can put a multiple of 20, 30 times, or in some cases, over 100 times earnings at a time when cost of capital is likely to stay high. What we call the mispriced cost of capital. Can we have, credit spreads being as low as they are, VIX being as suppressed as it is? I don't think so. Private equity businesses, all those to me look like real risks to financial markets. And then on the other side, you have energy shortage issues that will continue to be the case. Yes, you can have a recession, demand can be a problem, but that will continue to build up over the next 5 to 10 years. You still have agricultural commodities, what we call this resource under investments, which is related to almost all commodities. And then on the metals and mining side, you have electrification metals on top of this, gold thesis of central banks is starting to buy gold as a neutral asset. And finally, the Brazilian economy, which I think is also setting the stage to be very opportunistic for the following years too. So those are the sub-themes within this real political constraints created by the trifecta of macro imbalances.
Yeah, I definitely want to touch on those commodities you mentioned as well as the Brazilian market. But first, I'd like to get to the second macro imbalance listed in the report, which is systemic solvency problems posed by excessive leverage. Could you break that down for us?
Well, it's hard to believe we either have a hard default or an inflationary period, and so there's no way around this. And the easiest path is certainly is inflation, and so you would think that that on itself is already a real political constraint to allow inflation to be running higher than other periods. And so especially when you have the wages and salaries growth, you've got this long period of underinvestments in natural resources, creating what we think it's a real supply and demand mismatch. And there are parts of the commodity markets that will be even more pronounced, like metals and mining, which takes a real long time for us to go from undersupply to oversupply, maybe way more than a decade. And so those are issues that are emerging. And then you have this other problem of deglobalization, which is intensified also by the large amounts of debt. High debts tend to also magnify deglobalization trends. We've seen this in the past as well. That usually leads to war. I mean, I'm not claiming we're going to see World War III or anything like that, but any sort of conflict that will create a pressure of other G7 economies and other major economies to not only onshore the manufacturing plants, but also to go above and beyond and spend more capital where the logistics begin to go away from focusing on low cost, but less dependency of authoritarian regimes like China, but also what we have in terms of geopolitical risk. And so all those things are very important secular trends. And the fourth one is the irresponsible fiscal spending that we're seeing. That is, to me, a real sign of how policymakers just have not been used to living in a period where consumer prices stay high and can continue to run much hotter for longer. And look back in the 70s, even if you adjust for inflation, the level of fiscal spending was nowhere close to where it is currently. And that's a real concern. While military spending is rising, the Green Revolution, the social programs have to be run even higher now with AI and other issues or other breakthroughs. And so all those things are going to add up to how the fiscal agenda continues to be very extensive, and along with military spending, which I think it's at the early stages, and the interest payment from the debt itself. So those things are to me what forces governments to go back to financial repression and allow tangible assets to have their run. And if that's the case, I think most of the large institutions that tend to create the portfolios that will shape up markets for the next years are just really underallocated in natural resource industries overall, because there is still a fraction of the global equity market. So those are things that are in my mind regarding this.
So the third piece of the trifecta is embedded structural inflation. You've been touching on this as we've been speaking now. I'm wondering what you think it will take for inflation to come down and how long that could take in your view.
Well, the problem is that wages and salaries growth is, in my opinion, at very early stages to begin with. And it's not so much, yes, we can see cyclically things slow down a bit, particularly with higher paying jobs, because of the nature of the labor market today is very different than other times, meaning majority of the job openings and the things that we're seeing that look to be very exuberant in a way are coming from the lower classes, are coming from what we call unskilled jobs, or folks that don't have a high school degree that are really fulfilling those demands. And so we're not seeing real demand for high-paying jobs just yet. But the thing that is happening today is that the cost of living has risen significantly. It may not be increasing on a rate of change basis, meaning year over year, which is what everyone is focused. But what creates that cost of living rise is that the pressure from social unrest and others in terms of demanding higher wages. And I think we're at the beginning of that. If you just look at how much corporations spend in terms of operating cost and in terms of wages and salaries relative to how much money they make, that portion itself is at historical lows. And it's hard to believe that's not going to eat into their margins over time. And companies will demand that their wages will become a larger portion of the current profits or revenues of most of those companies. And so, I think that's really where that comes from. Those trends tend to be real long-term trends. Yes, we're going to see, probably a recession, a hard landing scenario, which would weaken the labor market. But when we come out of that, we'll likely see further pressure from those individuals to earn more money. The natural resource space is very important as well, because we know how long it will take to, we're not seeing. We went from a period where most of those companies were capital bleeders, particularly again in the metals and mining space, where they were very irresponsible on how they run their businesses. And now we're seeing the opposite of that. We're seeing they being overly conservative on capital management in general. And so that is creating lack of discoveries, lack of exploration budgets. We're not seeing the development of new projects coming online. We're not seeing all that we're seeing really is this M&A activity happening across the major companies, and they're just consolidating on the top. But if you look at their production themselves, they're not really growing. So that is a real concern to me when I look at those figures. I don't think mining companies are really focused on growth and other metrics that they should be focused on, especially at a time when gold prices are so close to all-time highs. And so those are all the things that are happening in that side of it that I would think that would also add to the inflationary pressure. Look at what's happening with the banks here in the US as well. I mean, the banking crisis that occurred, and the government just going above and beyond to make sure that those deposits are going to be in safe hands. And that is another form of monetary stimulus coming from the government, including the Fed and others, to ensure that the system is still stable. And that's ultimately the goal of most of those institutions. And so we're seeing clearly that they're taking the inflation route. The only situation that is happening is that the hard landing probability is rising, and so the inflation problem is being masked by those problems. But I think it's going to come back very strongly. And it's like Druckenmiller said, if the Fed decides to cut rates tomorrow for whatever reason that is, and I don't think that will happen here in the short term, but let's just assume they do. That would immediately unleash, probably the commodity markets to have another run. So, and why is that? And the reason for that is because big supply that remains so constrained. So, if you have the demand side starting to run more appropriately, you're going to see a big run in those tangible asset prices one more time. And so we have not fixed the structural problem, which is the supply issue. And so so those are my thoughts on this, because when you have inflation, everything needs to be repriced, because you now have cost of debt, especially being higher. The cost for a company to issue debt is going to be higher. Interest rates will be higher. The default risk will be higher, and that needs to be repriced on how you discount the cash flows of the business, and that is how you get smaller compression of multiples during inflationary regimes. We've seen this every time we've had an inflationary long-term problem in the 70s, 40s, and 1910s. All of those, the compression of multiples was the case, and it's hard to believe this time won't be the case, especially after seeing one of the best, most robust periods of growth of corporate earnings that we've seen in history.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
Let's pivot to Brazil now, and I want to touch on a post you made on Twitter that says overall Brazilian equities are now at their most undervalued levels since the impeachment of the president in 2016. Additionally, these stocks are being traded at similarly low multiples as they were during the global financial crisis. So, what makes Brazilian stocks a potential opportunity here? And are they shielded from any of the macro imbalances we discussed in America?
A healthy exercise that everyone should do, in my opinion, in terms of valuation analysis is just look at the CAPE ratio of different countries across the globe and seeing which ones are the cheapest equity markets you can find in the world. And you're going to see at the top of the list are places like Brazil. Most of the commodity-related countries or commodity-led economies are at the very top of that list. The bottom, you're going to find the other side of it. Usually is US is actually one of the most expensive ones. And another one on that list is India as well, which is a commodity importer. It's also an emerging market, but falls into a very different bucket of actually being not very favorable at a time when tangible asset prices are rising. And to me, what's happening with the Brazilian economy is classic throughout history as well. I mean, we've seen other periods that things get really, really cheap and everyone's concerned about the political risk. Well, what about the political risk in the US? The only difference is that one is already being priced with the political risk and the other is historical multiples. And so that divergence itself to me is really interesting. I'd much rather put my money on something that I think it's priced for failure than something else that is priced for perfection. And that's certainly the case in the Brazilian market relative to the US market. We've seen throughout history that commodity producers globally actually tend to follow very closely with Brazilian equities. And it's important to know the outperformance of that stock market relative to other developed economies over the last 20 months or so, which to me is very telling because I think this is just the beginning of that. The commodity market is very thin, small, and once other institutions begin to really deploy capital in the space, it is hard to believe they're not going to spread their wings into the Brazilian market as well. So to me, this is the real opportunity. I think it's a place where you want to not be going all in. It's a place where you want to deploy a little bit of capital there. If you get it right, meaning if the economy turns in terms of just attracting or having an influx of capital from foreign investors because of this, the tailwind of commodities, I think ultimately that will drive the overall economy in a much larger way than the markets are pricing. And it's important to remember Lula, which is, I think, the same way that the recession is masking the inflation problem. I think Lula is masking the opportunity. And a lot of people, every time you mention, let's look at buying Brazil, people get really defensive and like to say, why would I buy a communist market and other things? And look, this is not what it's happening in Russia. I am from Brazil. It's not what's happening in China. It is not a good development either. It's not positive. But if I would ever say what's happening today politically in Brazil, it's more fragmented than I've ever seen in my life, meaning there is a right-wing party in place. There is a development of a narrative that is against the left parties in Brazil. And that is something that did not exist even in the early 2000s when we had a bull market in commodities. And we also had a tech bust environment. And guess what? Commodity markets did very well. Lula came into the leadership at that time, and the Brazilian market performed very well as well. So, I am obviously, I think that what happened back in 2016 was very much linked to the commodity market. You don't want to be long Brazil when you have a bearish view on commodities. If that's your view, you probably shouldn't be deploying any capital in Brazilian equities. But I think that the banks look historically cheap. I think you can find commodity businesses that look really attractive. And look, it's just hard to find things that are cheap out there. And, Brazil knows how to handle inflation very well. It's been handling inflation for the last, call it 4 to 5 decades. And we'll probably handle inflation moving forward, better than developed economies. And so I think the political risk in the US is not priced in to the equity markets in relative basis with the Brazilian market. So, I think I've never been bullish on Brazilian markets, and I think it's a time to be just deploying some capital there. And I think things are really priced for failure right now, and I disagree with the markets.
Very good observations. And I do think that investors don't look outside of the borders of their own country often enough. So that is definitely something interesting to consider. Let's discuss gold now. The macro elements all seem to be in place. We saw gold come very close to reaching all-time highs recently. Central banks are accumulating it at record levels. We're seeing the crisis in the banking sector, as you touched on earlier as well, potentially creating a flight to safety. Some people seeing gold as a safe haven asset. How do you see gold performing here in 2023 moving forward?
I'm very bullish on the metal. I've been bullish for a while, and I think it is the only macro asset in the world today that is approaching new levels. Not Bitcoin, not NASDAQ, not the S&P 500, not oil, not agricultural commodities. It's only gold, really. And to me, that is very telling about those issues I've been referring with the trifecta of macro imbalances. I think gold prices are headed much higher. We've had issues with the production side where I think we're entering a multi-year of declining production of gold, which is mostly in line with other major bull markets we've seen throughout history. In the 70s and the early 2000s were the two major bull markets we've had. I think we've entered one, but I've never seen in my career a time when gold prices are at the levels that they are. And, buying in a property with gold in the ground is at depressed valuations. To me, that's a gift. And so I've been deploying a lot of capital there. And I have very high conviction that at some point, as gold really breaks out to much higher levels, and this market begins to, and it's normal when gold prices break out to new levels and so forth, which I think it will. Other folks are going to be looking for ways to take a more asymmetric approach rather than buying gold itself. That drives silver higher, that drives other things higher, like miners. But once they realize that the big major companies are actually carrying aging assets with deteriorating quality and also not focus on growth whatsoever, then the institutional capital should probably lead towards the early stage businesses in this industry, and that's where I'm really excited about. So, I've been deploying capital there for the last 2 years and really focus on, people like to buy silver when it breaks out and things like that. Look, we've been buying the seventh largest silver mine in the world. I'm not waiting for a breakout. I buy things when they're cheap. And then, if I have a thesis, that's the time to be buying, when everyone is either waiting for something to occur or just not having the conviction. And a lot of people end up having the conviction after the fact. And I don't think that's what a value and macro investor should be doing. Macro thesis is they may take a while to unfold, and the gold space has been developing for a while. We've seen central banks buying gold in a large way. More and more, being a neutral asset is becoming a very important aspect of gold, and it's just hard to believe that it's not going to become a big portion of portfolios as a defensive asset as we see issues developing. I think a lot of people have been looking at correlations like we've had in the last 2 to 3 decades, and I think correlations will look like the 70s. It is not like the 70s, but the correlations in markets will probably look like that, which means gold performing as a haven asset, meaning going up in prices as we see financial assets in turmoil. And I think that's going to be the case. So buying gold and selling stocks to me is a long-term trend. And I'm really excited about what the near future here will look like.
So what's your thesis for copper at the moment? This is another metal where a lot of the macro fundamentals are pointing potentially to higher prices. The whole push for the new green economy. An EV requires 4 times more copper than an internal combustion engine vehicle. renewable energy systems, I believe it's something like 8 times more copper required for those. Do you factor that in when looking at copper? And what do you think about the fact that some people are pointing to a recession up ahead as being bearish for copper prices, at least in the short term? What's your view there?
I think it could be bearish for copper. It's important to remember that a lot of natural resource industries actually perform very well during recessionary periods, even in the 70s. I think that it's, I like to have, I'm not just long copper, I'm not just long gold, I have shorts. And so I expect my shorts to work well in a hard landing scenario if that occurs. So let's get that out of the way first. And number two, so I'm not just fully one trade or one investment on the long side. I've got other hedges, but I do think that if you look at the chart of gold relative to copper throughout history, what you see is it's the same thing. If you have gold prices breaking out to new highs, ultimately, and I'm not saying tomorrow, but ultimately you will probably see copper follow. Another commodity or area that tends to follow gold prices is agricultural commodities, which is kind of unthinkable. Why would metals and mining be so linked to agricultural commodities? Well, guess what? Commodities are interconnected. Once one starts moving, the others tend to move along the way. And so I think it's all going to be a lot of different ways to really understand this market and make money out of this. There's a lot of inefficiencies. I think there's a lack of geologists in the space, lack of people that understand markets in the natural resource space. We've had a shrinkage of labor in the space as well, which is also very telling about how many few people really understand those industries and can navigate the space very well. So, there's going to be in demand. Money managers that know how to navigate the space will be in demand. The knowledge to discern good and bad investments will be in demand. Value investing would be a huge part of that as well, which is a huge part of understanding the commodity cycle as well, because they usually are linked. When you have this great rotation out of growth and out of just a top line priority and more into bottom line, and at a time when you have tangible assets and underlying metals and commodities for those businesses rising, you see real profitable periods for those companies. And I think people are just not really considering that that's going to be the case here. And so, like I said, most of the natural resource companies are a fraction of the global equity market today. And I think we're probably going to see a much bigger growth of that moving forward. So, yeah, I'm really excited about that. Yeah, maybe copper can decline in a recessionary environment. If that's the case, will be a great opportunity. That's not how I approach markets. I'm buying properties that have either likelihood or already have or in process of defining major copper deposits. And so that I think that opportunity will be, I don't know when things are going to run, but when things just start really running, I think prices are going to move very fast, and some people are going to miss that. So I guess I like to be early on that.
Well, let's finish on energy here. We're seeing WTI crude oil trade in a range between around $65 and $80 so far this year. Do you think we could see the price go back to the highs of over $100 a barrel of last year?
I think it's very possible. I wouldn't short oil at all. I think, you look at the fundamental of oil companies is very clear that they've been making, or I would say almost printing money in a way. I mean, the free cash flow growth in that environment has been tremendous. I think that it would be wise for some of those companies to diversify their risk towards metals and mining. I know that has been the wrong call in the past, because a lot of the times when they do that, it is actually at the end of the cycle for metals and mining. But this is the time where you want to be transitioning a little bit of your business from oil into other diversified parts of the commodity markets. Just my opinion on that. In terms of oil itself, I think it's becoming more and more a strategic geopolitical asset, and clearly we're still going to need oil moving forward, and it's hard to believe that what's happening, especially in the U.S. I mean, it's been mostly a response of in terms of the price action, price behavior has been a response of what the government has done in terms of depleting their strategic petroleum reserves, and I don't think that's sustainable. Now they recently said they're going to walk that back and maybe start buying and refilling their reserves. This is, I think this is right at the heart of why we've had such a period of weakness in oil prices. Yes, there's concerns about demand and other things, but you're still seeing the oil rigs is still declining significantly. And again, go back to the 70s when oil prices and oil companies actually performed very well, and also during the recessionary period. So, I wouldn't necessarily bet on that, but I think that I wouldn't be short oil here at all. I think people cared a lot about oil when it was trading at about $130 a barrel or so, and now nobody cares about it. And it's really cheap, and I think it's deserves to be part of a portfolio, and it is part of our portfolio. And I think it'll probably perform well in the next 12 to 20 months. I mean, I certainly remain very bullish in the space. I think commodity markets, by the way, they act, you see sort of domino effects falling slowly. I mean, the initial part of the commodity markets was the energy. 2021, 2022 was by far the best performance, annually speaking, in the last 30 years for the sector. So, it's absolutely normal to have a consolidation period. That's what we saw in the metals and mining industry for over the last 2 years. And now I think they are probably going to lead the way in the commodity space. If I would bet on a commodity today, I think metals and mining are going to be leading the way to the upside now.
Well, thank you so much for joining us today, Tavi. For those who want to learn more, could you fill us in on Crescat Capital and anywhere else you'd like to direct people online?
Happy to. Well, you can find more information about our letters and research on Twitter at Tavi Costa, but also on our website, crescat.net. We put out a lot of things in terms of very informative of, I hope it's very informative of our in-depth analysis in the macro environment. And also, if you have any questions about Crescat, you can find it there as well.
Great. Well, thanks once again, and look forward to having you on again in the future to continue the conversation.
Thanks, Jesse.